1 second.
Had you sent an email?
No, WhatsApp.
Yeah, oh, maybe it's down here. Oh yeah, there it is. I see it.
Okay. Good. I didn't want to think I was taking crazy pills or something.
Yeah, no, there's a lot more companies than that in there. It's a lot bigger list than that.
Yeah. No, I mean, well, whatever. I just saw it and I thought of you. I was like, you saw the whole thing firsthand.
Yeah. What's happened here too is that with all these companies spending within cash flow, investment bankers are out of business. They're not doing all these IPOs and capital raises and everything like they did for 30 years for all these companies that were way outspending their cash flow. So now it's gone the other direction.
Well, we've got a lot to talk about today. I know we're on the air. The funky music just ended. So today, hi, I'm Nadine Turman for Wall Street Beats. It is Thursday, August 7th, 2025. We have Ben Bry, Bob Morris. So I know roughly what we're going to be talking about here. Although there's a lot of earnings, so lots of stuff to cover today. Ben, I know you and we're having a solid day today. Anything you want to cover that you want to take a victory lap on, or is it new stuff you want to talk about today?
No, we can just talk about basically our stuff. I think everybody who's listened to me talk is that I'm in the camp that rates are coming down. Which is weird because I understand the stocks are at the all-time high, but that's usually when rates actually roll over. But yeah, the mortgage refi guys. So Rocket Mortgage, we really like. We have a long position there. Plus, actually, something that's kind of working that's interesting, which is a ratio call spread, which we sold the 17 calls to fund 2 times as many of the 20 calls, and then we're long the stock as well. And Rocket had a good quarter last week, and it has been great to use the rocket ship emoji, which I think is probably worth at least a couple turns of PE by itself in this mimetic market we live in. But that's doing well. This morning, UWMC, another mortgage refi, not as good a company as Rocket, but it had a little bit of a special situations thing going on where Shiba, how you pronounce his name, had a pretty big, large stock planned stock sale. So he was about 15 to 20% of the volume selling. And again, these happen with CEOs, and this is a small cap, so it kind of got dunked down into the fours. We bought it in the fours, the lower fours, and then this morning they printed a really good quarter, the best quarter since 21. And let's remember, mortgage refi business and pretty much everything related to volume in housing. This can go for furniture. This can go for realtors. This can, home builders were a little bit unique in the sense that they were kind of the only game in town there when existing home sales were dead. But like the housing ecosystem, let's call it, has been in almost a state of depression for multiple years as the rates have gone up. And so some of this stuff's starting to catch a bid. And, UWMC had 25% growth in originations and revenues, and about 20% year over year. EBITDA was up 4 times versus last quarter and up like 50-60% versus year over year. So that's quite good. The stock has an 8.5% dividend yield. So we'll be collecting our 10-cent dividend here shortly. So that's good. We were following our buddy Jeff Mackey and Peloton. It looks like they had a pretty good quarter, went free cash flow positive. Sounds like on the quarter, they said this quarter they'll be cash flow negative. So it tempered a little bit of the upside. But, it's funny. It reminds me
of... They're there. I mean, people just need to know the runway isn't 2 years. The runway, like they're near, they're landing the plane. They're landing the plane. No disaster in the air, right?
Yeah, I mean, if we use option theory to think about it, right? Like, as the expiration date of an option expands or moves out, the value of the option increases, right? And so in a company that people thought was a dead company, if all of a sudden they're free cash flow positive or even just kind of free cash flow neutral, not burning cash, well, then you have to revalue the option upside. And the underlying subscription business, I was talking with Jeff and Berna this morning, and we were going over it a little bit. Pretty good business. And I remember that from 2020 when we were short in the around 130, 125, just on the idea that the hardware part of the business wasn't a great business, right? We'd seen
Right.
that before with Nordic Track in the 90s. There's been lots of, the hot fitness item examples over the last however
Sure.
many decades. But the underlying subscription business is good. People get on
Yeah.
there, they listen to their favorite instructor. They pay $10, $15 a month like Netflix or any of these other ones, and it's really high margins. And so that's a smaller business, obviously,
Right.
than
Right.
when the old CEO was borrowing against his $100
Well, it's
million
steady.
stocks to
Yeah,
buy
but it's more
yachts and stuff.
steady, right? It's
It's
steadier.
a better
People,
business.
and they can
It's a
sell
better
stuff, maybe upsell them on other things. Yeah.
Yeah, look, it's a business, right? It's a
Right.
sustainable business that you can then uh, analytically put a multiple on, say, okay, how much growth, what's the addressable market, that normal analytical stuff that you do, and say, hey, look, the hardware business just is what it is.
Yeah.
They brought forward so many years of demand with the COVID and the pandemic that it totally got out of line. Super hated
Right.
stock. And kudos to Jeff, our partner, for getting involved in that in the $3-4 range. It's been pretty good, and so that was good. Tonight we got a big one. We got the Goodyear tire tonight, which I recommended on the show. Hasn't been great so far, down about 8 or 9% from when I recommended it and when around the place we bought it. So looking forward to seeing that print. That could finish off a great month over the last month. But looking forward to that tonight. Going to see what the comments are. With all the tariff stuff, autos haven't had a great print. But again, part of the thesis on Goodyear Tire is that they actually are a beneficiary of tariffs because they're a domestic manufacturer and they have
Yep.
only like 10% exposure. So they should be able to start gaining some share. They have a competitive advantage in the all important U.S. market. Also, one thing, this won't matter for this quarter, longer term, the torque from electric vehicles really wears on the tires more. So actual organic tire demand as EVs grow as a percentage of the U.S. fleet will increase. Now, again, that's a longer term thing, but it's for a stock that's been sideways, and I mean, used tire demand or replacement tire demand hasn't been a growth industry for quite some time.
Yeah.
It's something to put in your cap. And remember, Elliott, one of the best hedge funds of all time, is in there. They did 2 divestments in the last couple quarters, and they just did a debt issuance where they refied their debt, and so their credit has actually improved. So I like it. Stock has been mediocre. It's a small cap stock, so it moves around, but yeah, that's about it. And then, I guess Nadine and I don't know if you talked about this, Nadine, but we were buying a little India yesterday, and I'm not a huge fan of India, but maybe Nadine, you can tell what our thinking was there.
Sure. Yeah, the thinking was there, and I was just talking about that from Longbow, is that um, it's got hated because they're buying Russian oil, right? So basically, Russian crude's being offered to Indian buyers at more than $5 below Brent, right? So the discount was, close to zero 2 weeks ago, but it could be widening. India is taking advantage of that. And there was actually a thoughtful piece by Bloomberg yesterday on why it's going to be really hard for India not to buy Russian energy. But Modi's stuck in a bind, right? Because he's got this massive population needing the energy. But obviously, Trump wants to, number one, get tariffs, two, punish Russia until they stop the nonsense with Ukraine. Um, but Modi's got to run a country. So they slapped on, like, call it double tariffs. So you knew that headline was gonna, well, people knew something was gonna happen. It put it into more clarity. And so you kind of had the final nail in the coffin for headlines on India, but they've been doing solid. I mean, and some of the companies that sell internally to India this year are just, they're like rocket fire. They're like Palantir, right? But they're not selling military stuff to the US government. So there's a lot of money being made for companies internally, but you knew that the whole market, which is reflected by the INDA ETF, was going to get hit on the news. So Like, how much are we going to make out of it in a short term? Not sure, but it is up. And so it kind of did what it was
Yeah,
supposed to do, right? And you knew it'd bounce, and so it's bouncing, and that was the thesis. It was very short term, so you don't have to hold it forever. But certainly, as you continue to hear news hating on India, but once that's resolved, once there's that there's going to be a deal made. There's going to be a deal made, and once that also happens, that's probably your signal to sell. Unless you kind of made as much as you think you want to make, that's the catalyst near term, which I expect will happen the next few weeks. You'll get that kind of
and
announcement.
and I think that there was a little tell yesterday. If anyone didn't notice, Apple was up 8%, which is probably its biggest move non Liberation
Right.
Day, 60 vol world. But like on a vol adjusted basis, it's probably one of Apple's biggest moves in, I don't know, years maybe. Like it was kind of like the Trumpster comes out and says, "Hey, they're going to give us another 100 billion investment." It's like, dude, let's just get the close to the first 500 before you worry about that. But
Right.
then
Yeah.
it comes out that they're going to exempt them on India for their iPhone stuff. So then the
Right.
market was like, "Oh, okay, that's a big deal for them," and they took that higher. And so maybe that's a leading indicator for India in general.
Yes.
I think the overarching thing is Trump's trying to put pressure on Russia. India is one of
Yeah.
the big
That's all it
buyers
is.
of Russia.
Yeah.
And so he's trying to apply pressure to India in order to get pressure on Russia because he really wants to get that war. He wants to get that thing like,
Done.
like it was a campaign promise, and he's trying to get that conflict resolved and move to the next thing. And so I think this is just a side effect. Last thing I'll say
Sideshow. It's a
is,
sideshow to be able to do that, but at the end of the day, there's going to be a deal done, and then you get more pop.
yeah. And last thing I say is, as I like the mortgage refi guys, I also kind of like selling call options, which I know my man Bob Morris likes to do sometimes, against J.P. Morgan and some of the other money center banks. If you look at the last couple of days, markets had a nice rally off last Friday. JP's not doing anything. Wells isn't really doing anything. These banks are pretty full. They've had a really nice run, and as the curve flattens and the front comes down, let's just remember that's pretty bad for banks in general. And like the other part of it is, if you look at the move index, which is a weighted average of the 2 year, 5 year, 10 year, and 20 or 30 year treasury implied vol, 1 month implied vol, it's sinking. And so Harley Bassman, the guy who created that, said, if it goes below 80, you got to short it. Well, let me tell you something. Lower rates and lower vol are not good for banks. Those are their two biggest sources of income. So, I think banks have had a nice run, and I think they're capped here. So that's a nice source of funding. Not saying like, oh, they're going to be down 20%. That's why I like selling calls more than like, oh, you got to short it. But like,
Okay.
it's okay.
All right. And Bob, let's go over to you. I mean, I saw CNQ on my buy list in the last week on Longbow, just the signals, and you had actually Exxon, I think, was on there too. So what's going on in energy land? What's your current take, and what do you have for us? What stocks are you going to talk about today?
Yeah, so we had a slew of earnings this week, all the more oil focused names. And,
Yeah.
I've been in this business for, from the sell side to now managing a fund over 30 years.
Yeah.
And I don't think I've ever seen, apart from the commodity price, the level of value creation in this industry that we're seeing right now. And it's pretty amazing
Okay.
because there are four things going on here. What we've seen in the quarter is pretty consistent production beats by almost everyone here. And that's due to the continued or ongoing efficiency gains of companies drilling wells faster and cheaper. And it's also the well performance, the amount of production they're getting from the wells they're drilling due to better completion and technology. And if you go
Okay.
back 30 years, it took them sometimes 60, 90 days to drill a well just straight down a mile. Now they can drill a well down a mile and out laterally 2 miles in 4 to 5 days. And it's just incredible what is continuing to occur in this sector. Second thing is capital spending. It seems to be a theme that everybody says they're low end, the high end, or the midpoint of their capital spending guidance by
Right.
100 million this year. That seems to be like the magic number everybody wants to throw out there. But again, that's driven by efficiency gains, and in particular, Apache today, they reported last night, they're the big outperformer today because they said in the Permian Basin, despite beating production, they're dropping 25% of their rigs to get the same production they were going to get before. So
Yeah.
they're
Yeah.
saying, look, we can do the same as we originally planned with 6 instead of 8 rigs.
Right.
The third thing, and this is sort of out of their control, but this big, beautiful bill, the cash tax benefit is huge for these companies, and that
Uh-huh.
they're deferring cash taxes out several years. And that incremental cash that they're now going to have, they're giving back to shareholders. They're not spending more to go drill more wells, they're giving it back to shareholders. And that's the fourth point is this free cash flow that's being generated pretty much across the board. At least 50% of free cash flow is being given back to shareholders in the form of either
Right.
dividends or share buybacks. So again, in the 30 years I've been in this business, I've never seen
So
nobody's seen
where's
this
the
level of
love?
capital
Where's the
discipline,
love? Where's the love then?
and this amount of value creation in their operations and what they're doing. And so, the one name we said was our favorite to beat on the quarter going into the week was
Mhm,
Devon. And they met that
mhm,
expectation. They're the ones that beat the high end of their production guidance, brought
mhm.
down their capex. It's the one name I don't own that I'm intrigued by. So I'm keeping an eye on that. And, I probably should have owned it, especially given that I knew or thought that they would be the
Right.
one to beat expectations here on the week. But again, we mentioned Apache today on doing the same in the Permian with 25% fewer rigs. Oxy's outperforming today too, and I don't own Oxy, but the key thing there is that they announced nearly $1 billion in asset sales, which puts them closer to their debt level target to be able
Yeah.
to increase the
Yeah.
dividend to a meaningful level. And so that's positive, and that's what's really driving that name today. CAQ's down, and I think they did had a good quarter. They actually beat slightly. The difference was they weren't the one to go and beat and race. They didn't lower their capital
Right.
spending.
Right.
They're sort of down the middle. They beat, but one of those situations where everybody's saying, "Oh, we're lowering capex by 100 million, and we're at the high end or above the high end of production guidance." They were pretty much slight beat in line. Everything was fine. Bottom line, they beat. Um,
Yeah.
but it's sort of like relative to everybody else, it wasn't as exciting. But it's a Canadian company. They did this turnaround on the oil sands that they did 5 days faster than expected. They're going to drill some more heavy oil wells this year. And again, in the oil sands, their operating cost is $17.50 a barrel, and that's one of the reasons we like it. They've got such a low operating cost that in a non-natural decline asset is huge value in this name going
Yeah.
forward. So, again, apart from the commodity price and the volatility in the commodity, this industry or this sector is generating more value than we've seen in 30 years. And I don't think it's being recognized. I don't think it's being rewarded by shareholders. But again, a lot of that goes to the fears around or the volatility around the commodity price, both crude oil and natural gas. So,
So what do
I'm
you
sticking
do
with
as
it.
an investor then? What do you do
I'm
as an
still,
investor if you're seeing all this great news, but people just either aren't paying attention, don't care, so you're not getting paid?
well, I think eventually we'll get paid, and that's why I'm sticking with
Okay.
the names that I own.
So what's the
C&Q.
catalyst for that then, other than reporting good earnings, having less expenses, giving money back to shareholders? Like what's going to shake people up to put money into this? Like, do you need to see growth, or what are people looking for? Because obviously you need the money to flow there. So what's going to change the spigot from going into tech or wherever into this area?
I think it's just confidence in the commodity, which is often the case. I think there are a lot of fears around the crude oil price out there, and we're $65 a barrel. Natural gas prices have come in here recently with production doing very well. The one downside to all this is that with these efficiency gains, we continue to see both on the natural gas and the crude oil side companies building inventory of wells or what they call DUCs, drilled but uncompleted wells. So particularly on the natural gas side, but on the oil side, companies saying, well, we've got a lot of these wells sitting there we can complete and turn on very quickly, but we're holding them back. We're waiting for
Yeah.
a stronger commodity price to maybe turn on a lot of these wells in inventory that we've drilled, but we're just waiting to complete them. And so I think part of the fear is that um, there's not a big bull case today for crude oil and natural gas. There's more fear around, well, oil doesn't go up or maybe it goes down. Natural gas is sort of punk here. And in the meantime, as you pointed out, people are going to the sectors they're working like tech and elsewhere. And, again, we've always talked about the fact that oil and gas is not a huge part of the index. What is the weighting now? I think 5 or 6%. So,
Right.
if you miss part of the move, but you're in tech, or in the Mag 7, you really don't get punished or hurt a lot. But I think a lot of it's around fears around the commodity and gaining confidence in the sustainability of the or the upside in oil and gas prices, and then just over time, seeing these companies continue to beat and deliver, and taking those bottom line numbers that continue to do better than expectations, and seeing how that translates into value here in these names. But again, I think the stocks reflect closer to something around $60 oil and $3 gas, and for that reason, I think valuation wise, they're cheap. But again, it's just those fears around the
Okay.
commodity that sort of put a
Okay.
cap on it for now.
All right. And what do you think, Ben, about energy, given what Bob said? And why, if whether it's technically or otherwise, why are people not? Is it just the commodity, or is there something technical going on? What do you think about it?
Well, net gas kind of has been weak lately, right, Bob? And we've seen that come down to $3. And you seen the commodity, like we had that move in June where it was always like, oh, if we attack Iran, go to war with Iran, well, oil could go to $90. And what do we get? We got $10, and then it just came right back. Well, I think
Yep.
that
Yeah.
kind of gives some people like, well, maybe the risk premium isn't there like I thought it was. Now look, they didn't close the Strait of Hormuz, so maybe that would have taken you to the next level. But like I think that just people haven't made money in the space in a while.
Yeah.
And in this market, like people like to chase what works. And so it might be one of those things that when it starts working, then you'll have buyers
Let's get
higher
the money in.
basically.
Okay.
Yeah, that would
All
be
right.
my guess. Because when Bob says, I know in our Wall Street Beats chat we were talking about, oh, rigs are going down, but then I pulled up like the 30-year rig chart and just showed the rig intensity has, and I was involved with energy for a while, so that rig intensity, as Bob said, has like improved as technology and the shale stuff has gone on. So if they're gonna then give the money to the people, well, these guys were historically the biggest value destroyers, right? Like these guys didn't see a piece of land they didn't like to drill on, and
Yeah.
and uh, and so now that they're just returning capital, this is kind of what you want to see. Now you might have to sit and wait, but if you're getting paid to wait
Yeah.
and they're doing all the right things that they can control, right? Because they can't control the commodity, and so if they're doing the right things and Trump's getting people to buy more LNG and you got the power demand story from AI build outs. Like, down the road, we could see maybe oil peak out a little bit. But for now, I think you
Yeah.
just got to stick with what Bob's telling you, which is they're doing well. And if you want to own these things, you might be underperforming the market in this kind of euphoric stage. But, on the other side, and remember this also, energy tends to have a negative correlation with the market. So besides just the return, you're also buying a negative correlation into your portfolio, which is often some of the better things you can do to your portfolio more than just risk return. It's a third dimension of it, right?
Yeah.
Yeah, and
All
one thing
right.
that's you pointed out today earlier before we started the show, Ben, is that the M&A premium is sort of gone in this sector. There's been so much consolidation that there's not
Yeah.
a lot of speculation on M&A that would put some premium that company X, Y, or Z is going to get acquired or taken over.
Right, right.
All
I
right.
mean, there's not that many. There's not that many left.
I know.
No. Yeah. So
Yeah,
yeah.
we
So
got
maybe
Hess.
people are
Hess is
just
gone. John Hess is still going to make his
yeah.
Hess trucks, but it's ExxonMobil now.
Well, and that
I mean
that actually
Chevron. Chevron.
one little thing about that is, I do think that the average quality per name is probably much higher than it was in the past. If you think
Oh yeah.
about it, I mean, and you have less of the wildcatters. Like if we go back 10 years to I was very much a participant in a lot of deals and a lot of stocks in the last capex boom we saw, which was that shale 2008 to 2014 like period, and there was a lot of capital misallocation and capital was available. So, me and Bob could go get 10,000 acres and start drilling. And there was a lot of that. There's a lot less of that
Yeah.
now, which I think,
Yeah.
creates a little more stability.
Yeah, and there's a lot less
Yeah.
exploration. There's more just
Yeah.
manufacturing. You don't hear, there are people out buying XYZ because they're drilling a well offshore Africa that could double the value of the company. That's just not there anymore. It's more
Yeah.
manufacturing in the Permian and that thing.
Yeah.
Anything else for today? I mean, markets are up again, right? We got. I think people we're worried about the chips Now we don't have that. One thing that I'm looking at here is Lily Down. Is that the time to buy? I know we don't have David on today, but I did send him a quick note on WhatsApp. I would like his thoughts on them because they had a solid print, and all they had was okay, yeah, maybe their pill that they're going to be looking to have um, come out and be approved by the FDA had, reduced your weight by 12% versus 13 to 15. But if it's cheap enough and easy enough, like who cares? Like difference between 12 and 13 really that big? I don't know. Like it seems like there's some things really getting thrown out this earnings season. You have them beat, and it's like one tagline. They're spending a little bit more. Something wasn't perfect, and then they get hit, which seem to be the best buying opportunities for a lot of these things. I don't know if you guys have anything to say broadly about that trend or anything else going on today that could help people with their portfolios.
No, I mean,
Doesn't
like,
sound like
look,
it.
I think that there's the asymmetry of this earnings season is if you beat, you don't get paid that much, with the exception of the guys like, smaller cap guys, right? Like the things that
Yeah,
have kind of been the like left for dead. But the in the larger cap land, with the exception, I guess, Microsoft and Meta, I'll give them credit where credit's due. They had big moves and got rewarded for beats, but like the if you missed, you got hit hard. Like
yeah,
this market had
sure.
no tolerance for misses at all, and so like look at Crocs this morning, right? Crocs got
Well, yeah,
drilled this
yeah,
morning, and was tariff related like stuff a surprise? I mean, they sell boat shoes that they make in Asia. Like, how is this in any way, shape, or form? So you worry about that a little bit. That that in a market where 50% of equity AUM is passive, then another 25% is systematic. That you only have 25% of us dinosaurs left making decisions, and it might be more active part of it.
right,
But like, and by the way, the zero DTE option guys, or let me say it differently, 60% of equity flows are now due to options that expire in less than 1 week. That is by definition not a forward looking market, right? And
right.
so you got to think that like some of this stuff, fundamentals hit you over the head, and you can't, Whirlpool got hit like that. Texas Instruments got hit like that. ASML got. I mean, we've seen a
Yeah.
number of double Six Flags yesterday got drilled. Invisalign. So there has been like real misses, but yeah, that's I just think it's that asymmetry that the misses are getting three times
Yeah.
hit as hard as people are being
Right,
benefited for the earnings, for good earnings.
right. But going back to like who's trading, right? I was seeing data out of Apollo. I put it in the longbow arrows that there's cash on the sidelines, but that could be, um, I guess, exhausted is the right word by I think it's middle of September. So you could still see a melt up for a whole nother month or so before you have any kind of liquidity type catalyst to stop the melt up. So I don't know, what your thought is on
Well,
that, 'cause I know that, you've had a lot of bearish thoughts about the market, and totally understand, um, and you had some negative labor data coming out today, right? So people are having a hard time finding jobs. And but how do you figure out the runway to have a catalyst to at least stop a melt up versus, it's another thing to say something's going to tank versus just not melt up. So what's your thought on what are we looking for to understand whether it's, liquidity metrics or other kind of metrics to have a better sense of that you just don't buy every dip with retail.
well, you can continue to look at the curve. If the curve keeps flattening, and then you get the bottom like just keep going lower, that's basically means
Mm,
it's like we're getting ready for big rate cuts, and because you need to have that curve steepen. And I have a chart. I didn't send it around, but like since April, we've had 10 basis points or higher steepenings,
mm,
and each one of those after the steepening abated, and then you had the thing. So basically, think about we were having a curve flattener very strong, and it got down to about 40 basis points. And then on last Friday, we get the week jobs report, and there's a 16 basis point steepener that day, right? Because the front end of the
yeah.
curve went down 22 basis points, the back end was only down about 10. Well, okay, so then it gave back half of that, and so all these steepeners are then met with vol selling. Put guys come in and they systematically sell put skew, and that lifts the market. And so I can show you like the S&P after these steepenings had
Yeah.
1.5. Forget about the one in April because that was its own unique beast when we had that 10% up
Yeah.
day and when Trump warned everyone to buy it beforehand, which was unbelievable by itself. But so you get that kind of systematic. So if we keep seeing the curve flatten and economic data weaken, well, that's why I like the mortgage refi guys, right? Because the people
Okay.
who have been in the rate sensitive component, the rate sensitive equities can do well, but that would be liquidity negative. And then also remember the TGA, the General Treasury, can't talk, Treasury General Account, which is the Treasury's checking account at the Fed. Well, they wore that down to about 350 billion because of the debt
Yeah.
ceiling. They couldn't add new debt. Well, they're going to rebuild that by about 500 billion. So that should be liquidity negative. I think at
Yeah.
this point, earnings have held up okay. So we'll probably ride this into the middle of the month, the OPEX, and then we'll
Okay.
see what happens after that into September. But I just would remind people that '08 summer, August was okay. Fed almost raised rates. 2018 summer, it was like all glory days, and then it got real ugly for the Q4. September usually is where the rubber meets the road when everyone leaves the vacation, the Tahoes and the
Yeah, they
Hamptons, and
kind
they
of get
get back
back
in
and
front of the screen.
serious. Yeah. Yeah, they stop wearing
Yeah,
white. They get back. They become serious again. They're like, all right, what's the valuation on that? Right. Let's all get in a room again together. Yeah.
yeah. Stop wearing white. I like that. That's funny. But yeah, I think that's right. I think right now we're close enough now that we can get a continued little bit of floating into the OPEX, but then after that we'll start to see. But really, once September gets going, Labor Day's over, everyone's back in their seat. Remember also one thing about September, why it's seasonally bad, is it's the end of the government fiscal year and it's the end of most mutual funds fiscal year. So there's a lot of book cleaning and selling and end of year dynamics, and there's a liquidity strain on the banks, just as there was in the end of why March and September tend to be not great periods for risk assets because there's liquidity issues that are systematic related to banks. But no, in general, we're long. I mean, there's a lot of stocks
Yeah, we're
that
long.
we
We're long for
own,
now.
and
For
so
now. For now.
yeah, yeah,
Yeah.
yeah.
Yeah,
So
for now.
it's been a
All
good
right.
month to be long. So
All right. Well, we're going to wrap it up. Thank you, Bob Morris. Thank you, Ben Bry. Nadine Turman here for Wall Street Beats. Check us back tomorrow. It'll be Friday. End of the day. You can still wear your white and for a few more weeks. So put that on. We'll celebrate. All right. Goodbye, everybody.